Chris, that brings us to Chief Investment Officer's report, item 6.
Thank you very much. You introduced Scott, which was my first step. I am thrilled to have Scott come on board. It's been a big transition year. We've actually, I counted it up, we've had over 100 years of CalSTRS investment office, not investment experience, but just investment office experience, retire this year. So it's been a big transition. We're thrilled to have him on board. He's gotten up to speed, and hopefully I'll get a chance to all of you to meet him one-on-one at lunch. So I'll go through these slides fairly quickly. We have a lot of other things to talk about. The one highlight I would say, particularly for the teachers in the back of the room, this has been a slow year so far. You can see that we hit our high value way back in January. We have really been sort of sideways since that point. While the Dow has touched and may be touching a new high today, I'm not sure. It really is not much above where it was back in January. So I'll show you some charts later that show you the sideways movement. Here's the asset allocation at back at August 31st. I would describe it as we're tilting a little defensive. I'd really emphasize little. We have a high cash position relative to normal, and we're hedging out a little bit of our equity exposure, but again, just a little. We're talking about 1.5%. We started the year with about a 3% underweight, and that just proved too painful, so we reduced it. But we are worried about this market. Lots of debate about, in baseball analogies, are you in the 9th inning? Are you in the 5th inning? Are you in extra innings? So it's tough to say, but we're 9.5 years into a bull market, which is very long. So quite challenging times to figure out. This is the U.S. equity market in the year 2018 so far. You can see the highs we hit back in January, and we thought we were going to be in this trading range. I said that several meetings that we thought those highs would withhold. But what's certainly been remarkable is that here in the last months, we've broken through that. And so since about, if you really look at it instead of a trading range, look at the lows we touched in early April. The market's been on another climb, and we are continuing up in those new highs. So so far it's been a positive year, even though we spent about half of it being with the negative returns. Let's back up, because a lot of us have talked about the fact that we're at the 10-year anniversary when Lehman Brothers. Some of the board members might remember, I emailed you late on a Friday afternoon and said, this weekend is a kind of plant a flag. This is a tremendous weekend. We knew that Lehman, we thought they would be bought out. We did not expect them to go bankrupt, because remember, 6 months earlier, Bear Stearns had been in trouble and the Federal Reserve orchestrated a bailout, made another firm buy them. We were all quite shocked when Lehman actually went broke that Monday morning, and Merrill Lynch was bought by Bank of America. So when you back up and look at that, and that was a very traumatic and a very fast time period. Look at the steepness of that decline in 2008. That's why we have so many scars from that experience. It really happened from about September 15, even though it ended at March 9th. As you can see, it really occurred mostly between now and January. And when you look at that, you think about that, that's only about 115 days. And that's where most of the damage got created. And look at the tremendous move since the lows of March 9 of 2009. You can see the prolonged bull market. We've had some pauses in there. Look at 2015-16, where it kind of went sideways for a period during the election. Even in 2011, we kind of went sideways for a while. And the steep climb in the last couple of months, probably in the last year. What's amazing over this almost 10-year period now, the S&P and the Russell 3000 have averaged a double-digit annualized rate of return. And so that's what's really been driving our performance tremendously is the U.S. market. I'm going to contrast that with the non-U.S. market. And obviously, you look at those graphs, they kind of look similar. You've got that tremendous sell-off in 2009. It was an even deeper sell-off in the non-U.S. market. It bottomed out in early March again in 2009. And you look at that climb, but the slope of that line is not nearly as profound. And you're missing that massive run up we see in 2016. The non-US markets have done okay, but most people don't realize they have only averaged a 4% annual return. So the global portfolios that are 50-50 US, non-US have really struggled in this time period. So I also added this chart today, and I apologize it's not on the board webpage or the public webpage for people to see, but I thought it came out this morning and I thought it fit with our China discussion. This is a snapshot of the US and China trade. As I said, is it scuffle, a skirmish, a fist fight, is it a war? And you can see it constantly ebbing up higher and higher. And I think that's what people are paying attention to. Now, clearly the US markets have not been bothered by this. The Chinese markets have been. The domestic markets are actually touching lows where we're touching new highs. But I think most traders, and I would certainly tell you at some point, this is going to become a big issue in investors' minds. I think they think it's mostly just about shouting back and forth, but I would say, as Steve McCourt mentioned, and I think I mentioned to you last time, we're hearing from major U.S. companies that they are starting to see an anti-American backlash, particularly in China, but in other places. So this tough trade rhetoric might be helping some groups, and it's a change of pace for the USA, but it will have, no question, an impact at some point in the markets. And that's what I think we're all watching and trying to gauge. So climbing up the crow's nest and looking out on the horizon, trade, I would say NAFTA actually I think is a major issue that we need to worry about because Canada and Mexico are our number 1 and 2 trading partners. Then it's Asia. The rest of these on there are the same. The other one I'd highlight are natural disasters. Obviously, we've been focused on Hurricane Florence. Most people did not pay attention to the tropical typhoon that slammed into Hong Kong and caused damage. And probably Hawaii, sadly, is probably the best example I can give you where you've paid attention. They've said that hurricanes have gone around Hawaii for a lot, but now suddenly it is having to face the risk of hurricanes slamming into the island. So stronger weather is going to dominate the news. I've said it before, it's kind of like the Weather Channel may find itself being listed as one of the top channels because it's just going to be so predominant. With all those risks and things we worry about, the economy is growing at a high 3%, maybe even a 4% print on GDP. I've said it, certainly from a California perspective, it's probably one of the most hated bull markets and strong economies because it's not necessarily rising everybody up in these economy. It's a narrow group. Interest rates are still low, but are climbing. The Fed's going to meet here shortly and probably raise it. And the outlook for holiday sales is actually fairly decent, not surprising because of some wage growth. So Wall Street will start paying attention to that here shortly. The challenge is, as I said, lower for longer and where are things going to take us? Before I jump into, I wanted to give everybody an update on private prisons. I also want to say, because you've asked us in the past, how are we paying attention to the 21 risk factors? Let me just run down a really quick list of, this is our meeting back on August 8th of the ESG committee. We started with a focus on Sudan and Iran. We did talk about private prisons and immigration. Then we talked about Russia, Ukraine, firearms, marijuana, which is going to become a more major issue, labor issues, the drop in fuel standards, divestment issues on Turkey. We talked about the opioid crisis, plastic garbage, water bottles and straws are on our list, animal cruelty with the way McDonald's sources its chicken, Puerto Rico, predatory lending, sugar, Palestine, Israel, Iran, Saudi Arabia, Syria, Venezuela. Those are all the things that we are talking about and looking at internally, but we don't give you a constant list of all those things. But I just wanted you to know that. So private prisons, I guess the group that had come to talk about it, some of them have left, but I want to make sure you're aware what we have been doing and spending a lot of staff time. A majority since the July meeting has been on trying to organize these meetings and set them up. Some CTA representatives encouraged us to try and get some board members to come along with us. So we spent some time with the board members and general counsel figuring it out. The board members have decided to back away from that. Part of the challenge for us is visiting these companies, and these sites are in restricted states. And we can't get a blanket exception. We have to get per person, per trip. So and in fact, we can't even book it on the state system because those states like Texas and Kansas are blocked. So we have had a constant dialogue with these companies. One of them sent us their Homeland Security report and review that they've recently been on. We've had conference calls with their executives. Next week, Scott, as part of the senior staff and the corporate governance team, are going to visit a family residential facility in Texas. They're going to visit a maximum security facility in Kansas. They're also going to visit with another company, a residential center in Texas. John Stanton tried to get us meetings with the Department of Justice and Youth and Health and Human Services, but neither was willing to meet with us, so he was unsuccessful. But that's our effort so far to reach out to the companies, and I think that most of those will occur in the next 3 weeks, so we will get them done in September, hopefully. We've also been reaching out to NGOs, so I just want you to give you an idea. I'm going to go quickly down the list. We've already met with Freedom for Immigrants, which is a group in Oakland. We have a call scheduled with the Sentencing Project. Meeting scheduled with Enlace in New York, Correction Accountability Project in New York, the Women's Refugee Commission also in New York, and the ACLU National Prison Project in New York. We've requested a call from a group called RACES, which is a grassroots effort in San Antonio, because we can't get permission to travel there for that one. And we're requesting a meeting with the Human Rights Watch because we want to get their information and their side. And I am pushing the staff, but we anticipate, as I say up there, that we'll be coming back to you in the November meeting with a comprehensive packet of the pros and cons on this issue. I want to highlight, I listed 3 of the 21 risk factors, but we are looking actually at a total of 5. Respect for human rights, respect for civil liberties, workers' rights, discrimination, and the question of human health as to how these companies operate, how they treat workers, and obviously the issue with immigration and detention of children. CTA gave us a long list of questions. We're going to be able to answer many of them, but not all of them. Some deal with education, but we have given them to the companies. And so we'll put it all together in a very thick packet and bring it to you. Hopefully, we're shooting for November. Lastly, I wanted to highlight in the CIO report book a couple of things that we have going on coming up. Next investment committee meeting on November 7th, we are going to have an emerging manager reception. So I was going to ask Carrie if we could move. We'll have a panel of emerging managers to talk about diversity. And we'll have a reception. This will be the 3rd year we're hosting a reception for these managers. So we're going to invite the board members to join. And we'll hopefully put the panel toward the end of the day for the investment committee. This is where each of the asset classes kind of sets up a table, mingles and talks and interacts with these managers. We've been reaching out to them on a regular basis. You know that we participate in many of the conferences. I did respond to the NAIC letter personally way back in July. I didn't put it on the newswire, and then CalSTRS responded back to them already. So we've tried to interact with them. And I apologize, I won't be here tomorrow, but you're going to be well represented by the team for anything you need on investments. The CFA Institute is launching their diversity and inclusion research paper that they have finished, a study project. I was on their steering committee for the last 18 months, and tomorrow's the launch date in San Francisco, where they have about 15 recommendations for best practices for money managers and plan sponsors like us on how to do better at diversity and inclusion within your workforce. And whoops, wrong page. There we go, wrong button I'm pushing. I always want to highlight and you guys know very well, but especially in the back, we have videos, we have educational, we have reports. They're on the .com site. Click on the investment tab, and then you can see the overviews, and especially I highlight the multimedia in the middle of the page. Great place for people to get data and information. High school kids are required to have some finance education now, and so we're really trying to find a way to put more information out there, not necessarily curriculum, but stuff, tools teachers could use and make those available for high school to try and translate. We met with Karen yesterday, and I think it's a good way of translating the words we use and the things we say in institutional investing, how to make that real to people. So we'll keep doing that. Open to questions.
No questions. We're going to take a 10-minute break. So we could stick to 10 minutes. If the staff could just put the timer up there at 10 minutes, we'll start right at 10 minutes.
Timer.
All right, thanks. We have Margot and Rob here, and also have Makita's present. And before I turn it over to Margot and Rob, just want to point out to our committee that Makita has a memo in the back of this item. Their comments on this item and the work that they're doing with staff, and I'm sure they can contribute to the presentation as well or answer any questions that committee members have. It is a second reading, informational, but if the committee is comfortable, we could get to an adoption today as well. Okay, so turn it over to you, Margot.
Thank you, Harry. Margot Worth, Director of Private Equity. I'm here with Rob Ross, Portfolio Manager. This is, as Harry said, a second read for some policy revisions. I'm going to concentrate on the big three main things. The first thing is a whole new format, and this came about as a request from the board to have a standardized format throughout all the asset classes. So we're the first up here, and this is the policy format that a task force came up with. A lot of things were moved, and regular redlining did not seem appropriate, so you'll see coded here. Green is, I believe, moved, and there's deleted, and there's a key. And you also see annotated notes. You'll see annotated notes from the first read in pink, and then in a darker purplish color are changes that we've incorporated from the first read. So that is a new look, but most of the content, I would say, is the same. The second thing I wanted to bring up is we're incorporating a new sub-asset. This is called multi-strategy. This is a incubated strategy that came from the Risks and Innovations group, and we're pulling that over into the private equity portfolio. And that is 1% of our assets at this time. Rob, we have a chart here. With the addition of the multi-strategy, there are now 6 sub-assets. And so we are recommending that the portfolio be restructured with not only those 6 sub-assets, but 2 sub-asset groups labeled traditional and non-traditional. The traditional assets are the assets that are well established in the industry, well defined. They've been around for decades, and we have plenty of data on those. And that is on the order of 90% of our portfolio. And then in the other sub-asset group labeled non-traditional, these would be the converse. This would be sub-asset groups that are less well established and that don't fit neatly into the traditional framework for private equity. These would tend to be the more innovative and less commonplace in the industry. That includes the new multi-strategy, the incubated strategy, that includes special mandates, and that includes longer-term strategies. We had previously referred to those as core, but these are the longer-term private equity vehicles that are emerging as a new sub-asset class within the group. So there are several other, I would call them technical updates. They were discussed in detail in the July memo, the July executive summary. We'd be glad to discuss any of those if there are questions. But Harry, that's the main thrust of the policy revisions.
Chris?
I just wanted to add, we're not asking you to approve this. This is just an information item. But because it's such a dramatic change, we thought we'd go on a step-by-step approach. First, show you the proposed changes last meeting, this meeting. This is the slide Margot's on is really the big thing. We want to kind of see your nodding heads of yes, it's okay to move forward. And then we'll bring the final, which is to figure out the benchmarks underneath all those boxes. So it really fits in with Paul's comments of paying more attention to that. And that's what Makita is definitely working on. So we'll come back if you like that. We just didn't want such a big bite of the apple. We wanted to break it into pieces, make apple pie.
So John Haggerty and Stephen Hart are here. As I mentioned, they do have a memo that they've communicated to us, their views on the proposed changes. I would just ask John, Stephen, if you could just give us here, while we're in public session, a summary of and your overall high-level thinking on the proposed changes and direction for the committee.
So the memo you referenced speaks to our view that the changes are reasonable and logical. The conclusion to the memo makes two forward-looking references, one to things that have been mentioned already by your staff. One is to further refine what each of these buckets means with respect to what goes in and what the expected return and risk characteristics are, and then correspondingly assign in the future potentially different benchmarks to them. So that's our summation of this change to policy.
Is there anything that you think we would have to change in terms of our oversight responsibilities if we were to approve these changes? Anything we should be doing differently as a committee to oversee these changes?
Well, I think we'd say that what's being just on the slide that's up here, you have traditional, non-traditional, right? So there may be some different or additional kind of monitoring mechanisms one would want to think about for some of the non-traditional categories, right? What makes it there? What is going to eventually give the staff and the board conviction that there be even additional capital deployed to it? What are some of those milestones and things of that sort of nature? So that might be some things that might be some additional considerations for monitoring going forward.
So can perhaps when this comes back in November, that those recommendations could come to the committee in terms of monitoring oversight, separating them out? We would defer to you as our advisors some suggestions and recommendations, what that might look like annually, semi-annually, every 3 years. I really don't have any context to put it in, and it would be helpful, I think. Okay. Let's get to see if there are any questions, comments. Dana?
Good morning, Margot. And I'm sorry we didn't connect this morning, and I'm glad we're having another reading so we can connect whenever. How's that? I do have two questions for this morning, though. And one of these, it might be more appropriate when we start talking about the benchmarks and have that education, because while I thought I understood some of the private equity benchmarks, it became clear to me as I was reading this that maybe I don't have as good a grip on it as I should. And I have to tell you, this policy was a bear to read. I can't imagine what it was like to write. And so I really appreciate the effort you've put forth to try to do this. On page, now I've got to get out of that. On page IMV 176, when we are talking about benchmarks. So, and I'm okay if you don't answer this today, and we do it through the educational thing. It looked like to me that there's basically two benchmarks, one for those that are 10 years and above or 10 years and less, and then there's the weighted blend of the underlying sub-asset class benchmarks. So then I'm like, is that 2 benchmarks? And then we have vintage year, that's another benchmark. So we're actually using 3 benchmarks for like each one of these investments?
We will make that clear. I would say that we have always had 2 benchmarks, so one longer term, one shorter term.
Okay.
That's not a change, but.
And I guess,
could
I
see
guess I
the
didn't even, I
confusion.
mean, I must not have looked at vintage year as like a benchmark. So I appreciate having that kind of education. And none of our benchmarks in here are new, correct? They're all the ones we've had.
That's correct. So the traditional, again, that's 90% of the assets, that is under the newly adopted customized State Street Index.
Okay. And then just one
Can I
more.
add something to that?
Sure.
Just to highlight, we've found this summer, it really came to light that even the description we've written, I think Makita put it best, 5 investment officers could read that, calculate the benchmark 5 different ways, and technically they'd all be correct, but they'd be slightly different each time. So we realized we kind of got ahead of ourselves, and it's a little too vague. And it's complex, so we're going to try and, we might even put in a for example, but we really need to, that's what we're asking Makita to help with, to really come back and refine each of those. It's always a challenge of private equity because we want to know, is it worth being in versus our alternative, which is public equity. So that's easy. That's the long term. But then it's more that 3-year measure. And how are you measuring something that's kind of got about a 14-year typical life on 3-year time periods? And there was a survey done by all the state chief investment officers this summer. No one could come up with a good idea still. So, I remember, Dana, I'll go back. I remember a July meeting. You're nodding your head for those that weren't here. Dana said, gee, this sort of feels kind of rushed. Are we really sure about this benchmark? We still think it's the right one, but you were right. Again, we were rushed, and we're still uncovering issues. So we're going to really work with Makita to refine this, describe it, so we all know what we're doing, and try and find a way. The non-traditional, I would add to your comments for Makita, I think breaking it into these 2 subgroups makes it easier for you to have oversight. If they're all just a whole bunch of them in a bucket, it's harder to break them out. The non-traditional ones are unique and harder to measure. And frankly, a couple of them are measured more on time weighted. The rest of them are rated on IRR, not to get wonky, but those don't reconcile well. There are different ways to measure. Think of maybe, no, I have no good analogy. But that's what we've thrown on our high-priced consultants as you guys figure this out. So hopefully with those descriptions on IMV 176, those are what's going to be refined and changed when we come back.
And then just 2 more, Harry. Margo, on 178, under co-investment, there's a paragraph about the maximum co-investment commitment in any one case.
Yes.
Help me understand the difference between 10% of the size of the limited partnership investing in the transaction and 100% of the limited partnership's investment in the transaction. For me, that reads the same.
Yeah.
I mean, I couldn't differentiate it.
One we're measuring against the size of the fund. The other we're measuring against the size of the individual deal in the fund.
So it would be 100% of the deal in the fund.
That's right.
And the 10% would be the size of the
Of the
fund.
total fund, exactly.
Clarify that in the second round. Just say it more clearly.
Well, okay.
I don't know if there is a way to do that, but I mean, you guys know what you're talking about, so.
Limited partner could be making a huge investment, and this would limit our amount of risk of getting too much in that one investment.
That's right.
In another case, the limited partner, that the general partner might be making a smaller investment, and we don't want to be us putting in more in the co-investment than the partner's putting in.
That's right.
That makes sense. Thank you, I
Two
appreciate
different,
that.
risk controls.
Exactly.
And then the last one, and this is me, and I don't know if it's anybody else, but in the glossary, it looks like you're removing terms that I became really familiar with and I use when I'm talking about private equity, like the J-curve and things like that. And so I didn't have enough time to really go through it and make recommendations what I think you should keep. But I guess I wanted to know your rationale for removing things like that.
I would say this, we found that it's hard to write a good definition, and the definitions change, and, unlike 20 years ago when a lot of these were first written, there's a lot of other sources now. And so we thought we should keep it more to the terms we tend to use in the policy, rather than try to give our,
Within the whole world.
within the whole world.
That makes sense, okay.
Because we could define
And
many,
when
many.
we looked at them, a lot of the definitions were just really out of date or archaic. I guess J curve could have gone either way, and, that's one we could certainly put back in.
Well, I have time to look at it now more, so that'll be good. Thanks. Margot, thank you very much, and you too, Rob.
Is that it, Dana?
That's it for me.
Okay. Frank?
Speaking of the glossary, there seem to me to be a couple terms that are in the glossary that are not used in the body of the document. I brought that up to you earlier, and I was wondering if you concur with that?
We collected feedback from you, Frank, and from Karen, and we did incorporate the changes that you gave us in there. So if you're thinking about something that, I don't, yeah, all your comments and all of Karen's comments were incorporated into this version as requested.
Frank? Anyone else? Okay, seeing no other comments, and this will come back in November with anticipation that we probably would be in a position to approve it at that point. So if anybody has additional comments or feedback that they can get to Margot, Rob, or John and Steve between now and then, that would be most helpful. It would be time to adopt these changes. So thank you very much. Thank you.
So Harry, I know we're not allowed to vote. Can we take that as a nod of yes, keep proceeding?
That's
Thank you.
That's good, Chris.
Clarification, Chris.
Yeah. Next item is a continuation of the CalSTRS collaborative model. Paul Shantik, inflation sensitive. Welcome, Paul.
Thank you. This item is the open session item, covers kind of an overview of inflation sensitive and market challenges. I also have a slide deck that I'll run through if that's okay, Harry, and drop a little more information on you besides what we already have in here. One of the things that I found recently, and I stuck it in here, and you may have discovered the same thing, is when you go to a conference or you go to a setting, no one defines any of the terms that are going to be used throughout the conversation. So I thought I'd bring this definition of the collaborative model back so that we can all kind of take a look at it. What I wanted to focus on was the social capital, and that's kind of what this whole model is about. And the social capital for us and how we think about it is the value of the relationships that we have. That's with colleagues, friends, peers, consultants, and investment managers. And so what this model tries to do is take the networks that we have. We all have a network that we all live in, right? When you go to a conference, you're in the network of trustees. I'm in the network of investment people. You have investment people coming at you. You have consultants coming at you. So we all embed ourselves in these networks. And bankers, consultants, advisors are all part of that. And all of those people have information. Some of the information they have is good. Some of the information may not be so good. It may be something that you already know. But this is essentially a giant network of information exchange. And that's part of the social capital aspect of the collaborative model. But more important, I think, is there's an aspect of this model that looks to establish trust between managers and clients. In other words, not to think transactionally all the time. Like, I need you for this transaction. I won't see you for another 3 years when you come back to fundraise. So the idea is, what can we extract and what can we exchange back and forth? And that's to increase the knowledge and trust between the manager and CalSTRS. In other words, our idea is to learn some more internally about how they function, how they select investments, and how they do their job on our behalf. And we're going to get smarter about that, and they're going to get smarter about the kinds of things, investments that we're looking for. So that's not probably the best definition of the collaborative model, but as we're kind of working through this, kind of keep that in the back of your mind in terms of kind of where we're going with the collaborative model. One of the things we decided to do on the infrastructure side is give you an idea of the percentage of deals that occur in the infrastructure market by region. This is data from Preqin. And basically it goes to show you that about 64 to 72% of that data of activity in the market occurs in Europe and the US, a small part in Asia, and the rest of the world is very tiny. So the infrastructure market for us and inflation sensitive, since that's the biggest part of the portfolio, 60 to 70% of that occurs in the US and Europe. And then the number of deals is also, as you would expect, fairly substantial around the world. Again, most of those deals occur in Europe and the United States. Asia apparently goes up and down a little bit over time. So this is a total number of infrastructure deals done by region. So you can see the importance of the US market and the European market. Now this is a stack chart. It took us a while to put together because we got it down to the 7 categories, but we started out with about 35. So we've been taking all of the deals that were transactions that were done globally in the infrastructure market. And what we're trying to show here is that there's a lot of activity that takes place. It's estimated from a McKinsey report that I've got recently that about $2.5 to $3 trillion of spending around the world every year is in the infrastructure market. And the estimate, of course, as you've heard if you've gone to any conferences on infrastructure, is that number that really needs to get done is somewhere around 6 billion, 5 billion. It moves around quite a bit. PPPs, or public-private partnerships, make up about 5 to 10% of total investments in this stack. So diving into the stack a little bit, it's interesting. So you've got $1.5 to $2.3 trillion of infrastructure activity in the market. Renewables are now about 43% of that market as of 2017. They were at 34% just 4 years before that. The power and midstream, so generation, transmission, has held roughly around 20% of that market. And interestingly enough, with the presentation you saw in China, communications has increased from about 1.8% to about 4.5% of the market. So originally, infrastructure did not include things like cell towers and things like that, data centers, and now this become considered to be a major piece of infrastructure. Can you imagine walking around New York or San Francisco and not having your cell phone to navigate from meeting to meeting? So I mean, it's the interesting part. I was overseas, and I could, if my cell phone had gone out, I could not have gotten to most of my meetings because I used that to get everywhere where I was. Transportation has dropped from about 20% to 15% over time, and wastewater has also dropped as a portion of activity over the last. Now these, of course, can move around as certain projects or certain projects re-enter the market for sale, or new projects come to the market for sale. And just as an aside, the timberland market, we focus on timberland and farmland here in the US. Those markets are 190 billion, we estimate, and farmland is about 600 billion. Now, of course, they're bigger internationally, but our focus is just the US, whereas our infrastructure aspect of what we do is kind of worldwide. So I wanted to give you an idea of kind of the size of that market in terms of this slide. And then finally, you saw this from last time in terms of successful collaboration. We took this from the real estate presentation. We added the two on the far right. Free flow of information and shared vision. One of the things that we've emphasized with our managers is this desire to understand what they're doing, look at the diligence with them side by side, and understand how they're putting this together so that we can become commercially smarter about what these investments are, how they operate in the portfolio. And with that comes a shared vision, because we know we ask for certain things, they expect that information, and so we have an idea of where we're going, what's the idea with this investments, what's the thesis, how long do we want to hold it, what do we want to do with it. So with that, that's all the slides that I have at this point. If there are any questions on the item, I'll be back, of course, later on in closed session. I'll bring Charles Fitzpatrick, my PM, up with me in case you guys start asking really, really tough questions. And he can help dive into that. So.
Hold on. Thanks, Paul. Sharon?
So I have a couple questions, and you can let me know how much you can talk about in open session or closed session. Just give me some sense. A couple things. One, Paul, can you go back to the slide on the completed transactions globally? I think it was like 2 slides ago. What's accounting for that drop off from 16 to 18? I mean, that looks basically like, am I reading this right, that kind of there's been a significant drop off on infrastructure investment?
Which one? Which investment? 2016 to 2018. Just a drop off. Oh, well, 2018 is only, year to date. So that's not even.
So I get that.
Yeah,
So let's just look at 17 and 16 then.
That could be any number of things going on in the marketplace. There was a lot of fundraising that occurred in that time period. Actually, these charts will probably start to increase as more assets start to hit the market from funds that were created in, say, the 2007-8 period. So there just may not have been that many transactions that occurred in the 2017 period. Things do occasionally get fairly quiet in the marketplace as everybody has their assets in their funds, and then eventually they'll start to come back out into the marketplace. And you could see that start to grow just based on that kind of activity. Overall, I don't have a specific.
It might be interesting to be able to look back farther then or something, just to see how cyclical this is, because I mean, it's lower than 13, and
I don't.
you know how much I love talking about infrastructure, so I
Yeah,
always like to kind of look at the big picture, long term.
The data that we have is growing. This database, we didn't feel comfortable going back much past 2013 because a lot of this is relatively new.
Yeah, I would just echo that. I think infrastructure's been around a long time, but institutional investment in infrastructure really is pretty darn new and probably doesn't extend many years back beyond 2013.
Yeah, so that's why.
Interesting.
So I agree with you, Sharon, that there's probably, and Paul, about trying to get a grasp on the cyclicality. It's probably there, but it's sort of like we have to watch it occur.
As these databases get built out and more transactions, and these companies are working on this, just as they have in private equity to record transactions so people can do research. I suspect over the next few years, these databases will grow larger and become more robust, and we might be able to see if there's some sort of, what kind of cyclicality there is.
And then just a couple more things. Is it appropriate, can you talk about, since it's public knowledge, the CalSTRS and APG Alliance with Argo, I know we've made a second allocation. Can you kind of opine on sort of lessons learned so far in the collaborative model from that example?
I would probably take that to a closed session.
That's fine, perfect. And then, that's what I thought you'd say. And then I guess one thing I would probably add to that last slide, or to me, I know as we've been talking about, the collaborative model, one of the biggest, I love that it's long-term. I love it's relational, because I think we have a network. But I guess the one thing that to me is one of the biggest incentives is increased value to CalSTRS. I mean, that we cut out the middleman, quite frankly, and that we get to control terms. And so I think that would just be, to me, I know our members, and I know as a trustee, that's one of the most enticing things to me about the collaborative models. It feels like we can leverage our reputation, our long-term relationships with great organizations like APG, but also ultimately it just adds value, right? That it actually allows us to make more money for CalSTRS.
Correct, and we'll cover a little bit of that. I've got a little slide that kind of lays some of these things side by side so you get an idea of kind of the fees and what happens. But yes, that's absolutely true. And I think for us, the important thing is not only are we saving fees, but we're becoming a much more knowledgeable organization overall as it spreads throughout all investment officers in terms of those kinds of contacts and the things that you need to know. And, you want to be the one that's asking those good questions. And so that's also a part of this shared vision, the free flow of information back. It's not always easy, but that's what we're always striving for. And people, our managers are understanding that's what we're looking for.
So we have Paul, Karen, and then Lynn. Paul?
Thanks. Paul, just going back to that slide that Sharon was asking questions about. So this is dollar amount in US dollars of completed transactions globally. Completed transactions, what type? Are these public-private partnership transactions? How are we?
All transactions in infrastructure. So
Well, they're not, I mean, they don't include muni bond transactions, right? So what does it include?
Their public-private partnerships probably would be a part of this, but again, but they're not broken out. And the estimate is those are roughly 7 to 10% of the entire market. So these are going to be communications companies, power and midstream companies that we're buying the assets from. Same thing with renewables. Those are private transactions where someone will throw up a wind farm or solar panels, and we'll be the ultimate buyer of that.
So it's privately owned infrastructure.
Correct.
Generally, it's not muni bonds. It includes P3s, but other things. And 7 to 10% of this is P3s.
Correct.
So if you look at 2016 then, we had about 2.4 billion. Or was that 2.4 trillion? 2.4 trillion, okay. So 10% of that would be 240 billion of public-private partnerships. So you're figuring that around the world. Okay, so that's sort of the market opportunity that we look at when we're doing investing through funds for public-private partnerships.
Of the public, we have essentially one manager. The Meridian is the manager that we use for public-private partnerships. Most of the rest of the fund managers that we'll be involved with will be value-add managers that are looking in these more private sector, communications, power, midstream. They're going to be looking for assets when they start to put their portfolios that are going to have a higher return than that of the P3.
Private partnerships are really not sort of the majority of where we're looking, right?
Absolutely, that's
Got
correct.
it, thank you.
I mean, just following that up, Paul, do you have any sense, this is the industry, but how about your portfolio? Does your portfolio mirror that over the last couple of years? Pretty close?
I wouldn't say it mirrors that. We've certainly seen more activity in renewables. And as you know, with the climate initiatives and things like that, we've been doing this for a couple of years. We're pretty close to being in the portfolio percentage-wise where we're comfortable. We don't want to do much more. And in terms of the power and midstream in the United States, that's a very active part of the market here in the U.S., so we have a good sizing of that. We actually have a nice size in communications. Water and wastewater is very difficult to get, so that didn't surprise me on the slides in terms of what I saw. It's very difficult, and transportation is also something that we want to get more of. That's more of a European thing in terms of transportation. If you've ever been in Europe, you know that there's a lot more transportation alternatives for public transportation than there are here. There are more toll roads in Europe. So, in terms of putting the portfolio together, it's been interesting to see and, what the bigger slugs of that are.
Lynn? Could you just ring? What did I do? Did I do something wrong? There you go.
Thank you very much.
You're welcome.
Thank you for the presentation. I was just curious, and maybe this is more of a closed session discussion, but can you talk a little bit about the trade-offs or the balance between investor protections for CalSTRS versus continuing to be nimble and flexible in order to, be attractive to some of these investors?
In terms of, you mean investor protections, what are?
Well, I guess the governance of how you'd set up these accounts.
In terms of control of the investment?
Yes.
We find that for the most part, and of course, in the funds, that's limited governance. Working with APG and Argo, we're a part of that. We do not have the majority control, but we have a significant say. And in terms of other kinds of things we're looking at, we don't have control, but we do have a significant say. So I think in starting the program out, trying to go for control, like where CalSTRS controls the assets, we're not at that place yet. We're much more comfortable working with managers and others and having a significant say in what goes on in individual assets, in say accounts and co-invest, or mostly in accounts. But in terms of funds, and it's a different story.
Steve, do you want to contribute to the answer? Thanks.
And I'll have more to say in closed session on this item. But one thing the board should be aware of is as you move from pure fund investing to a collaborative model, the opportunity set of the number of managers that are willing to collaborate is reduced. So one of the balances that staff has to do is you have a larger number of funds you can select from and a fewer number of managers who are willing to collaborate. And so that's part of the balance of risk, opportunity, fees, et cetera.
Okay, so more to come this afternoon then.
Yeah.
Okay, thank you.
Anyone else?
No.
Thanks. I think that's, I look forward to your thoughts, Stephen, on that. Because as and thanks, Paul, for the presentation. If I recall correctly, inflation sensitive is 1.8% of the overall portfolio. But as I look at our long-term need to generate 7% over the long term, that plays a role in our objective to get to 7. So it's not Margot's private equity, it's not June's public equity, it's not Glennon fixed income, it's not Mike DeRay in real estate, but it has a role to play. So as I think about the CalSTRS collaborative model, what the objectives are, more control, lower cost, without giving up returns. As we think about inflation sensitive going forward, if we are to advance this conversation for this asset class, I think it will be helpful for me to understand if we were to move in that direction. That may require additional staff, people with different expertise, build out your team, what that might look like, is for us to understand what the cost of that would be and how the objective, more control, lower cost, without giving up returns, how moving towards a collaborative model, even if it's on the margins, a smidge, that's a technical term, a smidge will generate that extra return for us, will offset the additional cost of hiring more staff, et cetera. I'm sure you're thinking about that, but that's how I think about this is if we're to do this, you and the consultants need to convince me at least that we're not going to give up return and we may actually at the margins be better off over the long term. Does that make sense?
Yes. Real estate will do their presentation later on today. We're going to watch that closely for cues for ours. We've got a draft sort of started already, but we know that that's something that you're going to look at. It may not be as clean as real estate because there's more. They have more history. We don't have as much history, but we can give you. I think in closed session you'll see some of the fee differentials that will, help to piece that together. And when we come back to you, we'll make sure.
I think it would be helpful if Stephen and Neil are also thinking along those lines as well. Speaking for myself, I would benefit from some really fine tuning on that analysis. Because on its surface, it sounds like a good idea, but I still have to be convinced. Neil?
I would just sort of add one thing to the way you're thinking is you're going to be going through an asset liability study next year. Imagine if you just shift the program from 2 to 3. Right. You've increased the program 50%.
Yeah, $2 billion.
Yeah, that's right. I mean, that's an additional $2 billion you're putting to work. So that, I mean, it's just that kind of shift is a 50% increase in your effort from organizational standpoint.
Okay. All right. Anyone else? Okay. Thanks, Paul. Look forward to a closed session.